Number 3 of the 3 most important articles you need to read as a consumer of financial planner, if not you're going to be firing your own financial planner and doing it yourself, or if you're going to go to the business to offer guidance as well. So either way, I talked about number 1 was Bill Bengen's 4% rule. That was incredibly informative back in the early 90s. Number 2 is Ty Bernicki's Reality Retirement Spending, another wonderful, wonderful tool that really changed the paradigm of how we look at financial planning, using income needs first as opposed to assets, what you have for assets. How much income do we need? And then we can put the two together. And this is going to be using your home equity and your assets, your entirety of your assets to incorporate in your financial plan as well. So let's dive right into this, my friends, here at the Heritage Wealth Planning YouTube channel. Don't forget to smash. I got to come up with a different one. Now I'm so addicted to saying smash. Smash, share, and subscribe, all right? And then smash the like button, share, subscribe, comments, all right? Let's go into this one. So here's from the Journal for Financial Planning. What was this dated? Back in 2015, if I'm not mistaken. I don't see the date on here. I think it was 2015. By Barry Sachs and Stephen Sachs, PhDs, JD. I'm not sure who Peter Neuwirth is. I don't know who that is. But anyways, Journal of Financial Planning. What's this? Got a date on this thing? I don't remember. But anyway, I just came across this maybe a year ago, actually. And it really changed. But this is where I started looking at reverse mortgages, absolutely. And the premise of this, my friends, a lot of people just don't have that much in retirement savings. They just don't. Now, a lot of those same people who don't have that much in retirement savings do have home equity assets. That's for sure. The majority of people in retirement do not carry a mortgage. That's for sure, too. So what logically says we got a lot of people who don't have a mortgage. A lot of people don't have liquid net worth and retirement savings. Well, guess what? And they have equity. So why would we not use that equity as a form of retirement planning? I don't know. Now, I know there's lots of fears out there. That's fine. This isn't saying you should do it, but I think it opens up a whole different approach for people who are kind of thinking they're on the cusp if they can retire or not. All right. So let's go to the executive summary. I might split this up into 2. Let me just get my thing out here because I think there's a lot to go into here, and I'll probably split up to 2. All right. So 4:15. The paper examines the effect of using reverse mortgage credit lines to supplement retirement income by 2 types of retirees that had not been addressed in previous literature. Those whose retirement savings are significantly below those of the mass affluent, and those are house rich, cash poor. Results of this analysis demonstrate an important contrast with results of the earlier literature, specifically the greater percentage of home value when coordinated with a retirement savings portfolio resulted in a substantially greater percentages of the portfolio that can be withdrawn. The paper suggests a new alternative to the 4% rule that can guide planners and retirees towards optimal cash flow withdrawal strategy. This new rule takes into account the total of the retiree's retirement savings plus home value. The quantitative analysis of this paper uses the same spreadsheet models and strategies first presented in the journal back in 2012 by the Sachs brothers, and this paper builds on that work. Okay, so Stephen Sachs, PhD, is professor emeritus of economics at the University of Connecticut. He maintains an economics consulting practice in New York. All right, we got Barry Sachs, JD, PhD, is a practicing tax attorney in San Francisco. Specialized in pension-related matters since 1973. And Neuwirth is an actuary with 38 years experience. Hey, Willis Towers Watson. Hey, cool. I know people who work there. Recently retired from there. He maintains an independent actual consulting practice. So obviously these guys got some academic chops behind them. All right, so using home equity to enhance retirement income is an emerging topic in the financial planning profession. Research on strategies for tapping home equity to boost the sustainability of retirement income drawn from securities portfolios is quite recent, though. The concept was first introduced in the JFP by Howard Evansky, which I tell you, Howard Evansky is a big deal in financial planning. Pfeiffer, I know who Pfeiffer is. Salter, Sachs, I don't know them, but I've read all their stuff, both of which focused on home equity access by reverse mortgage credit lines. Evansky is I forgot the other lady out in Texas. I could have sworn there's a lady down there. I'm drawing a blank from Texas Tech. I can see her image right in my head. Anyway, let's see. The previous literature examined model retirees whose ratio of home value to the value of their retirement savings was 1 to 2. Sachs and Faust suggested expanding the research to retirees with different ratios. This paper followed that suggestions, broadening the range of retirees examined using two strategies. Like much of the existing literature on reverse mortgages, this paper uses the term reverse mortgage to mean home equity conversion mortgage. All right, so basically they're saying before we're examining model retirees whose ratio of home value to the value of the retirement savings was 1 to 2. So you had a $500,000 home, you got $1 million retirement account. $200,000 home, $400,000, you get that. Although the data on retirement savings and home equity have been amassed from a number of surveys, there's not much coherence among the data sets. Some data sets consolidate data from age 55 to 64, 65 to 74, or others focus on the age group 63 to 65. And data on retirement savings is often tracked separately from data on home equity, making it difficult to draw conclusions about the distribution of the combination of home equity and savings. Some attempts have been made to correlate and combine home equity and retirement savings. For example, my man Joe Tomlinson, drawing a blank, Pfeiffer, and John Salter, I can't remember Pfeiffer's first name, showed retirement savings, home equity, and home values for married retirees aged 63 to 64 who had non-zero retirement savings. And they're going to show, and for you on the podcast, you can't see this, but basically what Tomlinson et al. Say is that percentage of retirement savings, married median home equity, home value, and retirement savings by percentage of retirement savings. So percentage of retirement savings, if you had 50 to 74.9% of retirement savings and you're married with positive retirement savings age 63 to 65, your retirement savings was $383,000, your home equity was $200,000, and your home value was $295,000. So home equity as a percentage of home value is 68%. Mortgage debt as a percentage of home value is 32%, and home equity as a percentage of retirement savings was 52%. So again, you had, let's just say for simplicity, $400,000 retirement savings, and you had $200,000 of home equity. So your percentage of home equity to retirement savings in that case was about 50%. Your mortgage debt as a percentage of your home value was 32% on this is the scenario. Now there's 5 different quintiles. I'll let you all look at it. I'll put a link in the show notes. If, as some economists project, the use of home equity for generating retirement income grows in prevalence in the coming years, I'm telling you, it's going to, this conjoint analysis of the total resources available to retirees will improve financial planners' understanding of the true state of retirement readiness of the population who will be retiring in the next 5 to 10 years. All right, as previously noted, it can be difficult to draw conclusions about the distributions of the combination of home equity and retirement savings from the existing data. Nonetheless, most segments of the population, from the mass affluent, who fit the top quartile of Table 1, we'll talk about that in a second, to the almost affluent, home equity represents a significant component of total assets available. Rather than extend the analysis of Tomlinson, Pfeiffer, and Salter, this paper focused on 4 representative retirees and explored more deeply the reverse mortgage strategies that each type of retiree might use to meet their retirement income objectives. As part of that analysis, the following question was explored. Is there an optimal percentage of total retirement income resources that the broad range of retirees could withdraw each year that would maximize retirement income while minimizing the probability of exhausting all assets before the end of retirement? Let me pause there for a second because I'm drinking coffee. I put a Milky Way in there, a small one, pretty good. Remember, the whole point about retirement is make sure we don't run out of money. I mean, that's what it comes down to. Now, if you want to leave legacies, that's other things that do that. But retirement, I just want to make sure I don't run out of money and become a burden to my children. Not using your home equity just inherently doesn't make sense to me. I mean, because it's there, especially if you're literally going to run out of money. In addition to the combination issue noted earlier, another complicating factor in the data is that about 20 to 30% of retirees have mortgages still outstanding on their homes when they retire. Because of the reduced home equity credit line available when a conventional mortgage is yet to pay off, the analysis presented here considered only those retirees who own their homes free and clear and whose value is consistent with the home equity values. However, the majority of retirees own their homes free and clear. I'm telling you, that's huge. The majority of retirees own their homes free and clear. Therefore, the terms home value and home equity are synonymous with this paper. We are not talking people who don't have mortgages. Home equity and home value are synonymous because the majority of homeowners own their homes outright. You got to understand that. This is different for people who have a mortgage. I've done videos on reverse mortgages in that regard. We're not doing that here. As noted, Table 1, which I just talked about, shows median values of both retirement savings and the home equity in order to better capture the range of financial situations among the population of retirees, as well as the acute retirement income generation problems facing the retiree with significant home value but limited retirement savings. This study considered not only typical retirees, but also house-rich, cash-poor retirees. And they have a description of the 4 groups here. They got retiree number 1, mass affluent. They have $400,000 of home equity and $800,000 in savings. Retiree number 2, house rich, mass affluent. $800,000 of home equity and $400,000 of retirement savings. So you got a 1-to-2 ratio, home equity to retirement accounts, and then we got a 2-to-1, home equity to retirement accounts. Number 3, almost affluent retiree is $150,000 of mass and home equity and $300,000 of retirement savings. And then number 4, $300,000 of home equity and $150,000 in retirement savings. Again, home equity is being used synonymously with not having a mortgage, so just with your total home value that you don't have a mortgage. All right, so let's take a break here real quick. We'll do part 2 and talk about the different scenarios of these 4 people. So don't forget to subscribe, and I'll put the link up there in the show notes to continue on for part 2 of this. Thanks.